fortunate to have Kyle Macintyre join us. So he's one of the investment directors at Firetrail Investments, and you've been a long history with the team there. So you've come across from the initial beginnings at Macquarie as well, Kyle.
Yeah, that's right, Pete. It's been really exciting. We launched the business in 2018, but myself and the rest of the team, 10 of us left Macquarie to start Firetrail, and we're doing exactly the same thing that we were doing at Macquarie, running the same strategies, the same people, the same process. But I suppose the exciting thing is being owners in our business and investing alongside clients as well, which is always a good thing to have that alignment, I think.
Yeah, I'm happy with the decision so far. So it's all been a good decision to sort of go out on your own.
I mean, we loved Macquarie, but geez, it's so nice having your destiny in your own hands. And we took a lot of the elements of that business that we liked and a lot of the cultural aspects that we liked and implemented it at Firetrail. But there have been zero regrets leaving and starting our own business. So it's been a lot of fun.
Brilliant. So what I was hoping to pick your brain about today. So we've got a lot of clients, and a fair few of them are new to your absolute return strategy. So that was sort of the main one I wanted to pick your brain about today. And for those that are new to the strategy, can you just run through it like at a high level? Because I do a very poor job of explaining the strategy to our clients, I'm sure. So it's a long short strategy. So what does that mean?
Okay, yeah. I mean, when people say long short, you might go, oh, geez, long short fund. So long side of the portfolio, basically what we're looking to do is buy companies that we believe are undervalued, where we see robust earnings upside in these businesses. So we're investing in Australian companies within this portfolio. We're looking to buy companies that look cheap over a 3 to 5 year view. And we've really got an eclectic mix of positions within the portfolio there. So you've got some companies with some really strong growth outlooks within the portfolio. So companies like a ResMed that specializes in sleep apnea devices, helping you and I get a better sleep. I don't know if you've heard.
I haven't got a CPAP machine, but we do have a few of. We're familiar with the business. We've got a few clients that I'm sure will be very, very familiar with the product.
Yeah, well, I'm sure if we've got any snorers out there, they've definitely heard of ResMed and sleep apnea. And basically, they specialize in these devices to help you get a better sleep. This is a company with massive growth prospects in the US. The total addressable market for something like a ResMed is around 400 million people. But, 80% of people don't even know they've got sleep apnea who have it. So huge growth runway ahead of them. And this is a company listed on the ASX. So some really great growth names in there. We've also got companies in there that we believe are really undervalued today. So companies that your clients would know well, like Qantas. What we found is going through COVID, nobody wanted to own airlines.
Yep.
And part of our job is to do the research and say, okay, well, what's Qantas going to look like in 3 years' time? Is this a great buying opportunity to buy Qantas at $2.30, $2.40, $2.50 a share during the pandemic? Will things get better? Will the earnings profile get better? And really do some deep dive research there and find undervalued companies like Qantas.
And from the sounds of that, like you take a fundamental view of companies, like you bottom up looking, or you sort of take a macro view. How does that come together?
So it's all what you'd call bottom up fundamental research. So we spend a lot of time talking to company management, CEOs, CFOs, chief operating officers. But then we go down a level and we speak to line management, business managers, competitors, industry suppliers, really getting a good understanding of what's going to drive a company's earnings and their share price into the future, and really trying to work out whether or not the market is across something and trying to gain a different edge on a company that maybe isn't evident to the market at the moment. So, with Qantas as a really good example, most of the market through COVID was saying international flying isn't going to be here forever, right? Yeah. And we sort of agree with that. When you look at our earnings numbers, we have international travel getting back to around 25% of where it was in FY19 by FY24. So you're talking not a very strong recovery in international. But to find valuation upside in Qantas, you actually don't need an international recovery. The Qantas domestic business is such a profitable business that in the next 3 years, because of cost out opportunities, because of people starting to fly domestically again, And because of a rational pricing environment between Qantas and Virgin domestically, you're actually going to see those businesses have record profitability years. And so to buy that company on 5 or 6 years worth of earnings, when it usually trades on 9 or 10 years worth of earnings, for us, that's very attractive, particularly given the earnings upside from the domestic business coming through. So that's how we think about it, just thinking a little bit differently and doing deep fundamental research. Some research projects can take months and months to do, but it's all about doing the work, gaining an edge and understanding these businesses and what's going to drive them into the future.
Yeah, and you've got direct equity strategies in there as well in the Firetrail stable of funds. So are you sourcing information from those teams, or how does that sort of get shared across the different strategies?
Yeah, that's exactly right, Pete. So we got a team of 21 at Firetrail, all investment-focused professionals. So we've got analysts who are covering different sectors within the Australian equity market. We've got a few global focus analysts. The fund we're talking about today is Australian-focused. And then we've got risk managers, people who are thinking about execution and trading, etc. So it's a really big team with input into this strategy, coming up with different ideas. And then not only are we looking at ideas to buy, but something that's really different about this strategy is we can short companies where we think the share price is going to go down.
And are you allowed to share any secret sauce there about how do you? Because doing the short positions, I imagine, is a little bit different. Or how does that differentiate between the long position?
Yeah, well, a lot of people, when you talk to short, a lot of people don't like shorting. When you say shorting, it's almost like a dirty word when you speak to people. What I'd flag is, we're not shorting businesses to go to zero. So typically, some of these offshore hedge funds and managers will look at businesses, they'll go out into the press and they'll say, this is a horrible business. They'll release papers and they'll really try to be destructive to a business to cause a fall in the share price. That's not what we do at all at Firetrail. What we do is we really focus on the earnings of a business, and they could be businesses that are high quality businesses that we like. But if we've updated our earnings for a company into the next year and we believe that the company's earnings guidance is too high and our numbers based on our analysis come in, say, 20% below where the company's guiding, for us, that's an opportunity to short that company. And what you find is that companies' share prices will generally follow their earnings. So if a company's says it's going to earn $100 next year, but it actually delivers $80, that's a 20% downgrade. And typically what you'd see is that company's share price would fall in the range of 20 odd percent. So our job is to work out what is the company actually going to deliver next year. And if it's going to be below where the market expectations are or where the company's guiding, it's a candidate to short in this portfolio. And our investors get to profit from the research that we've done pre that result coming out and from that falling share price. So it doesn't mean the business is broken. It just means that right now the company's guiding to a certain result. We believe it's going to be worse than what they've said. So you've got earnings risk coming through. And so what we'll do is we'll short that company leading into the result and try to make money off that falling share price for our investors. So a good example would be in the past year, AGL Energy. And so we did a massive piece of work on AGL Energy. We were actually looking to buy it because it was looking really cheap. Yep. And we did a huge piece of work into the national electricity market. And what we found is that the national electricity market is seeing a huge influx of cheap renewable power coming into the grid. And it's actually having a major impact on wholesale electricity prices. So in the past 2 years, wholesale electricity prices have fallen from $80 a megawatt hour to $40 a megawatt hour. So a 50% fall.
Yeah.
And who does that impact? Whose revenue does it impact? Whose earnings does it impact? Well, it impacts the incumbents that are selling electricity to retailers. So AGL Energy has seen their earnings halve in the last 24 months.
That can't be good for share price then.
That's right. Well, the share price has halved as well in the last 12 months. So share prices follow earnings. You've seen the share price follow those earnings down by around 50%. We did a huge piece of research on it. We saw the opportunity. We shorted AGL. It doesn't mean we don't like AGL as a business, but structurally those earnings are in decline, and so we've used as an opportunity to make money for our investors. Now, the interesting thing about being able to short in your portfolio is that markets don't always rise. typically over the long term, markets do rise, but there are
don't tell investors that. Surely,
that's
up,
right. That's
up
right.
and to the right, isn't it?
Well, our job at Firetrail is to be able to make money in rising and falling markets. You know, in the Firetrail Absolute Return Fund, if you've given us a 3-year investment horizon, we've never delivered a negative return. That doesn't mean we're always going to outperform, but typically we've been able to protect investors' capital in some pretty volatile equity market periods where equity markets have fallen substantially, particularly during COVID, right?
Yeah.
And the reason we've been able to do that is by identifying companies that we believe will outperform, buying those in the long portfolio, but also profiting from companies that are going to fall in the short portfolio, protecting to the downside. And so that's why you can smooth out those returns by buying and shorting and benefiting from both rising and falling share prices.
Yeah. Oh, great. And so with that sort of the ability to have both sides of play both sides of the field almost,
yeah.
Is it equal numbers of stocks? Is it an equal distribution, or how do you go about the weightings? Does it sort of differentiate between sort of long and short, like how many ideas you have on each side of the portfolio?
Good question. So in terms of the portfolio, the long side of the portfolio is typically a lot more concentrated. So we've sort of got 50 to 70 stocks in the long side of the portfolio of our best ideas right across the spectrum. So we'll invest in really large companies, we'll invest in smaller companies, all the way down to, $200, $300 million market cap size companies. So you're getting diverse exposure, but fairly concentrated. In the short portfolio, it's a lot more diverse for our portfolio. And the reason you have that diversity in that short portfolio is the maximum you can make from shorting a company is actually 100%. So let's say a company is $100. The max that company can fall is to $0, right? But what your investors would know from looking at things like Afterpay or CSL through time is, companies can rise infinite, theoretically. And so there's a risk reward scenario that's asymmetric there. It's skewed. And for shorting, it's skewed to the downside. So what we want to do is increase the breadth in the short portfolio. We've got a lot of smaller short positions. So if we get a company wrong, and God forbid we short something like a CSL in the last 20 years, which would have been horrific, it'll hurt the portfolio a little bit, but it's not going to have an outsized impact on returns. And so the way we approach those fundamental shorts is let's have a lot of small short bets where we think there are going to be earnings downgrades, but let's spread them out so that if we get any of them wrong, it's not going to have an outsized impact on portfolio returns.
Yeah. And then, so given you're invested in equities, like how correlated should people expect this to be to whatever the ASX 200 is doing, or sort of whatever, like an Australian index? So are they expecting whatever they're seeing on the news each night, that's what your portfolio is doing?
It's going to be completely different. And it's hard to wrap your head around, right? So we're investing in Aussie companies in the Aussie equity market, and yet the return profile is going to be very, very different to what you get in the Aussie equity market. The reason it is different is because we are actually hedging equity exposure in our short portfolio. So we're hedging the long exposure with the short portfolio. And so equity market up 10, 20, 30%, you're not actually going to get the benefit of that rising market coming through. But more importantly, equity market down 20, 30, 40%, you're not going to see that coming through this portfolio's returns. Remember that short portfolio, as share prices fall, it's actually generating a positive return. So hedging out falling equity markets. So this portfolio is going to outperform or underperform based on our stock selection. So good news. If we're outperforming,
so have you got a good team in there to pick stocks though?
Yeah, that's right. You know who to blame. So if the Qantas and the ResMeds of the world are underperforming materially, that's what's going to impact portfolio returns. It's not going to be the equity market direction or the equity market movements. We're actually hedging that risk out in the long short portfolio. The result is a portfolio's returns that are very differentiated to the underlying index, but still looking to deliver, cash plus 7% over a rolling 3 to 5 year period, which we've been able to comfortably deliver to investors. So a similar equity-like return, but taking a lot less risk and a less bumpy journey than you get investing in the equity market. What I'd flag is, though, equity markets have been strong in the past 12 months, right? So we're not going to follow it when the equity markets are doing this. But over the medium to long term, we've had a pretty similar return profile to equities.
Yeah, and when you sort of think about the role you fulfill, so when we're using you in clients' portfolio, you sit in our alternatives bucket, not the equities part of our portfolio. So,
which is exactly where we should be sitting. It's even though we're using equities as the opportunity set, the return series you're getting is going to be very, very different, and it's going to be an alternative that diversifies your overall portfolio.
Yeah. And are there any particular market conditions where investors should go, this is the prime time for you to do your best? Or is it really an all-weather type of strategy where it doesn't matter if the market's going up, down, sideways, providing that stock picking's working, the fund can deliver on its objective?
Well, I think we're always going to do really well as markets move towards fundamentals. So, if markets are being rational, and I mentioned share prices following earnings before. If share prices are following earnings, this fund is going to do well. And importantly, you look at markets through time, there is a very high correlation between share prices and earnings through time. Now, when can that dislocate? There are short-term periods where things can skew away from fundamentals. Periods like the 2000s where you had that huge tech bubble. People didn't care about fundamentals in the 2000s. So it doesn't mean we're going to underperform materially, but versus the equity market, we're going to underperform when everyone's buying companies, no matter what valuation, because, we're a fundamental investor and we are focused on valuations and earnings. I think most long-term investors should be focused on valuations. It's no different to purchasing a house, right? You could have the nicest house in the nicest suburb, on the waterfront. If you pay $1 billion for that house, I guarantee you it's going to be a bad investment if you overpay for it.
So, this is going to be a sensitive point here. We've got a few big property investors in the client base. So.
But it's exactly the same when you think about investing in companies. If you overpay for a company, it's going to be a bad investment. It doesn't mean in the short term it's going to be bad. Things can still rise even though they're expensive. But what we've seen over the long term is if you overpay for a company, it's going to be a bad investment. So when things dislocate from fundamentals, that's probably going to work against us a little bit. But over a rolling market cycle, we've seen that this portfolio, over a rolling 3 years, you give us a 3-year investment horizon, been a pretty positive experience for our investors.
Oh, that's really good to hear. Now, there's some wonderful insights. So that's great. So really appreciate your time today. That's fantastic. We're long-term investors here. So, 3-year plus horizon, that's music to my ears. So.
Well, I can't tell you what will happen in the next 12 months, Pete, but I can tell you.
I was going to ask you that. Well, picking sort of where everything's going to land. So hopefully it's a smooth ride into Christmas. And we'll hopefully get you back again next year and get an update. But really appreciate your time and your insights today, Kyle.
No, I appreciate you and your client support, Pete. Thanks for the chat.
No worries. Thanks, Pete.